Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry.
Sincere greetings and salutations, loyal listeners. Amidst the backdrop of poisonous politics, I say that kindness remains an absolutely free lunch for us all. It requires no capital, carries no risk, it compounds powerfully, and it's monetizable in so many ways. As you probably know, I derive a lot of inspiration from quotes. And while I've used many quotes from Mark Twain along the way, I was not aware of this one. Kindness is the language which the deaf can hear and the blind can see. That is powerful. There's a lot out of our control, more than we can comfortably admit to. But kindness is something we can be intentional about. Let's do it together. The subject at hand is, no surprise, risk. Buffett once said that risk comes from not knowing what you are doing. I suppose I learned this the hard way when trying to jumpstart an old car many years ago with the cables reversed. Risk in markets, as my dear friend Steve Warren once said, is about having your hand forced, unwinding a trade when you really didn't want to. That's always about sizing. Getting the sizing wrong is about misestimating the volatility. When realized volatility spikes, your portfolio essentially gets larger on a value at risk basis. What I find myself thinking about constantly is forward-looking volatility. This is especially the case now because we have been mired in quite a muted environment for volatility at the index level. 2-month realized S&P vol is just 10. That is certainly low, but there are some nuances worth highlighting. First, since July, realized vol on up days in the S&P is 10.1%. But notably, realized vol on the subset of days when the index falls is just 8.2%. That's not an expected outcome. Here's a second nuance. Take a small sip of water, a vol nerd moment fast approaches. The, quote, vol of realized vol is also on strike. Over the last 2 months, the range of 2-month realized vol is just 2.5%. That is, the highest 2-month realized is 10.7, and the lowest is 8.2. It's as if realized vol has its own stablecoin, barely fluctuating from an anchor around 10. It's as if that soothing, polite British umpire's request of, quiet please, at Wimbledon has been honored market-wide. Realized vol is, after all, quite rude. In brief summary, we have 3 things going in terms of realized vol at the index level. It's low, it's especially low on down days, and it's remarkably stable. My take is that the combination here can play tricks on how we think about risk. Clearly, the opportunity cost of hedging goes up when realized vol goes down. Not only is there a shortfall of realized vol causing losses to owning options, when it's so rock steady, we are bound to extrapolate its continuation as such. We're prone to letting our guards down. Now, with the benign realized vol environment noted, let's advance our discussion to the market price of insurance. If options are your jam, as they are mine, a main question to always consider is the insurance worth it? As Alec Baldwin suggested in his movie with Meryl Streep, it's complicated. There's no obvious or definitive answer. But we can effectively frame the question and consider it from a few angles. Let's start with the assumption that the global risk asset is the S&P, and the starting point for evaluating insurance should be pricing of SPX options. Then, in thinking about the price and value of insurance, we can consider, first, the price of S&P vol versus its own history. Second, that price versus other expiries and strikes also in the S&P. Third, that price versus how the option carries, that is, a comparison of implied to realized volatility. Fourth, that price versus similar and related types of macro market insurance, instruments like the VIX and HYG. And lastly, that price versus an assessment of the forward-looking risk profile of the markets, rates, Fed, inflation, geopolitics, elections, earnings, valuations, the risk of an accident, etc. Let's evaluate these in turn. On the first point, at roughly 15, The level of 2-month 40 delta S&P vol is in the 38th, 17th, and 30th percentiles over the last 2, 5, and 10 years. It's obvious that the window matters, but also clear that options are nominally inexpensive. Let's also remember at the same time that price does not equate to value, as we will lean on in number 3, our discussion of carry. Secondly, the 3-month 95% put vol is high relative to the 3-month 105% call vol. That is, the skew is on the steeper side. There have been times, for example in 2022, when the very flat skew facilitated collars, that is, long puts financed by selling a call. These were done at economical levels because the skew was so flat. Today is not one of those times. On number 3, while the S&P vol is nominally low, it's also high versus the level of realized vol. That is, options are not carrying all that well. There are a few ways to measure this, but the ratio of implied to realized is around the 80th percentile over the last 2 and 5 years. The carry of S&P options has been very difficult in 2025, and candidly, I'm surprised that implied volatility is not lower than it is as a result. 2-month realized vol has been steady, as mentioned, around 10 for 2 months. Daily S&P moves of greater than 1% have become a rarity. Fourth, S&P vol is quite high and also quite low relative to some of its proxy hedges. First, S&P vol is low relative to VIX vol. For example, the ratio of the VVIX to S&P vol is in the 96th percentile. Last year, we found wickedly cheap VIX options around May and June of 2024, and owning calls wound up being a home run. Unfortunately, these options are considerably more expensive now. However, HYG vol is very low to S&P vol, in the 5th and 3rd percentile over the last 5 and 10 years. HYG options are almost impossibly low in price. They got that way because the index has delivered very, very little realized volatility. However, what I like most about the setup here is the way in which the entry point of such low implied vol provides so much opportunity for lift in the option price. Take, for example, the November 80 put on the HYG, currently marked around 5.5 vol. Move that vol to 7.5 without even moving the spot price, and the option premium increases by a hefty 54%. That's tremendous convexity, especially given that high-yield credit spreads clock in at already very low levels. Lastly, when positioning long optionality in a portfolio, some assessment of forward-looking risk developments ought to be part of the process. Put me in the camp that the recent substantial decline in realized volatility masks a dangerous level of fragility in markets. To be sure, option prices are not definitively cheap to backward-looking realized vol. They rarely are. Options are, however, valuable in light of a concentrated, highly valued market with uncertainty building in the jobs market, in tariffs, in U.S. debt, and in an unfortunate yet dangerous escalation in not just global affairs, but in the U.S. political civil war. U.S. governance is a problem that does not fit into an Excel spreadsheet awaiting some at NPV discounting exercise. The purchase of car or homeowners insurance is not really a strategic decision. We must have them. In those insurance policies, as the song goes, how much does it cost? I'll buy it. Market insurance is different. There needs to be some timing component associated with the decision to spend premium, and that comes down to value. For me, the price of insurance is a very good deal versus the totality of risks. Let's explore this a little further and in the process update some of my thinking on portfolio construction. I've been suggesting this year that the GOAT portfolio, that is, great opportunities and threats, is a sensible way of staying long a market that is pretty difficult not to be long, and simultaneously sprinkling in diversifying assets and market insurance. With respect to the market exposure, I'm certainly not smart enough to beat the S&P. I think most attempts to introduce sector tilts don't wind up adding a lot of value. The GOAT portfolio consists of 84% S&P, 10% gold, 5% Bitcoin, and a 1% allocation to quarterly 3-month 95 put spreads on the S&P. It's marginally outperforming the index in 2025, but with decidedly better risk characteristics. For example, when the tariff tantrum hit in early April, 1-month realized vol on the S&P surged to 50%. For the GOAT portfolio, it reached only half that. And that is because a central part of the GOAT portfolio is the put spread overlay. Pricing right now on a 3-month 95/80 put spread is 1%. This isn't as low as, for example, 2017, Trump's first full year in office. But this is Trump's second first full year in office, and he is a more significant source of market risk now than he was then. The put spread is good value against a backdrop in which market valuations are high, correlations are low, the labor market is fragile, and the U.S. political civil war is an untenable source of risk. Gold continues to be a standout in 2025. Remarkably, it exhibits 0% correlation to the S&P this year, along with a hefty 35% return. On the 6 days in 2025, when the S&P has fallen by 2% or more, an average decline of negative 3.6% on those days, gold is up, on average, 83 basis points. Interestingly, gold is not just 0% correlated to the S&P, it is 0% correlated to Bitcoin in 2025. The diversifiers are themselves diversified. Set against the base exposure to the S&P, a key shared attribute of Bitcoin, gold, and the insurance overlay is the notion of acceleration. These assets can see their values increase sharply as investors quickly crowd into them, especially during times of market uncertainty. Let's focus on gold and get some help on the acronym front. You know I love me a good, high-quality acronym. In fact, I was on Bloomberg TV recently, and with some help from ChatGPT, was able to share an acronym for the show's name, Surveillance. Here's the clip.
After Hours special, Speaking in Acronyms with ChatGPT, will be coming to a podcast provider near you. So what's the acronym?
Okay, are you ready?
I don't know if I am, but maybe go ahead.
Surveillance, systematic uncovering of risk through vigilant examination, information, liquidity, leverage, activity, news flow, cross currents, and economics.
Love it.
And that took 1 second to generate.
Absolutely.
Let's get some help on gold. Hi, ChatGPT. What's an acronym for political breakdown using the word gold and including the word governance? I'm glad you asked. Gold equals governance overwhelmed, legitimacy diminished. I continue to believe that gold call options are underpriced relative to the escalation of U.S. political uncertainty. I put forth that this long stretch of ultra-low and well-behaved realized vol on the S&P is masking a deterioration in the market's foundation. First, let's note the feedback mechanism between calm and convexity. Calm is bad for those that paid to be long convexity. The rally in the MSI, Market Stability Index, is the pain suffered from being long gamma. The MSI simply measures the percentage of days the S&P daily move is within plus or minus 75 basis points over a 3-month period. It's currently tracking 3 of every 4 days. The Gamma Index is a running tally of the P&L of owning weekly straddles on the S&P. Even if you got long this index at the prior S&P all-time high on February 19th and rode that volatility through the tariff tantrum, you are still down in owning Gamma. By, quote, renting the market via options, you walk away from large losses, effectively avoiding the plumbing problem the owner is responsible for. This long string of low realized vol is the owner's equivalent of a maintenance-free property. It's hard to get yourself to buy an umbrella after a wonderful stretch of sunshine, even if it's on sale. But the owner must constantly ask whether the property foundation is becoming less stable. Sometimes the grounds shift beneath our feet, and without corroboration from market prices, we miss it. For me, the escalation of U.S. political uncertainty definitively weakens the foundation. Many citizens and all of the media are stricken with either TDS or TAD, that is, Trump apologist disorder. But you need only observe the escalation of our political civil war to safely conclude that it is a source of risk not sufficiently priced. Sadly, this war between the left and right and their powerful media proxies intensified greatly this past week. Gold is the asset that will benefit most from further escalation, which seems a trend firmly in place. Gold itself has option-like qualities. It's also a stock-up, vol-up asset. A joint rally in the underlying and the implied vol can produce enormous increases in the value of call options. Let me highlight a chart on correlation that I recently posted on Twitter. First, a caveat. Correlations come and go. You can't really trust them. However, it's very telling to look at a scatter plot of major macro asset correlations measured since May to both the VIX and DXY. These assets include prominent macro underlyings like the S&P, TLT, and HYG. I'd argue that having a positive beta to the VIX and a negative beta to the dollar is a valuable attribute. And as I showed in the chart on Twitter, it's uniquely a gold characteristic. As mentioned, that can change, but it's here for now, and it's an important source of risk diversification. Quite interesting and opportunistic to me is that longer dated GLD vol essentially sits basically where it was on February 19th, the previous all-time high in the S&P. In fact, the low delta put and call tails are identical to where they were back then. I'm coming back to a trade from months ago that we executed with a lot of success, as I think it sets up again, and that is buying longer dated, very low delta calls on the GLD. Gold and gold vol are beneficiaries of U.S. political unrest, a problem I unfortunately only see escalating. The idea is that gold is something of an option. Calls on gold are options on options, and the very low delta, long-dated calls on gold are, you guessed it, options on options on options. As we wrap up this discussion on portfolio construction, I want to reinforce a couple of main points. First, insurance ain't free, nor should it be. Imagine if you called up your friendly broker looking for homeowners insurance, and you got to the part where you were presented with the premium, and it was blank. Sorry, what's the cost again? Might be a logical question. To this, you were told it's your lucky day, and it was on the arm, as they say, a year's worth of protection for free. Sounds great, Greg, as apathetic younger brother Bobby said in the Brady Bunch, but not really realistic for a profit-seeking institution. So don't expect free insurance in the market either. But we always ought to be hunting for value and trying to find some alpha in implementation. And that brings us to trade construction and insurance, especially as the giant quarterly collar is soon to be rolled. To preview, it's an S&P 3-month 95.80 put spread that is paid for through the sale of a roughly 105 call. I say pony up the 1% per quarter for the put spread, but eat the premium. Selling that call is a bad idea at current market prices, a function of just 11 or so implied vol. The risk reversal index on Bloomberg measures the ratio of premium on an S&P 3-month 95% put to that of a 3-month 105 call. It's at 1.7. The put costs 70% more than the call does. That is a lot, and leaves the index in the 97th percentile when measured over the last 3 years. A good argument can be made that it reflects the friction being absorbed by the giant quarterly collar. A risk reversal as tight as 95-105 ought not to have so much skew, 6+ falls in my view, and it likely reflects the presence of the trade itself. It's a friction absorbed by the hedger and paid to the skew seller. As a result, tight collars cost too much. Let's think about this from the standpoint of put-call parity, which tells us that puts and calls of the same strike are really the same instruments in disguise. Of course, there are some frictions like bid offer, borrow, and dividend uncertainties, but put-call parity is just arithmetic. In contrast to the Black-Scholes model-driven arbitrage, there are no assumptions about the underlying distribution of the asset's returns needed in put-call parity. Thus, there's no vol skew, meaning differential between put and call vol, for a put-call combo when the strikes are the same. As we start to widen the strikes, 99-101, 95-105, 90-110, etc., we generally see that put vol is higher than call vol for an index like the S&P. For the hedger, how much higher really matters. Some of the largest systematic hedges are effectively doing 3-month 95-105 collars on the S&P and paying 6 to 7 vols of skew for the right to do so. That has real price impact against the hedger. While this skew isn't new, and while there is empirically more realized vol to the downside than the upside in the S&P, the vol skew is especially high given how tight the strikes are. Currently, the 3-month 95-105 collar yields vols of around 11 and 17.2. There's just about a 50 delta. Reducing your delta by 50 with a 95-105 collar that pays away more than 6 vols of skew feels expensive. Let's contrast that for a second to the Hang Seng Index, where structured products flourish, often leaving dealers with Greek profiles that tend to flatten the skew. In the Hang Seng, the 3-month 95-105 vol skew is nearly zero. For me, the beauty of options is how multidimensional the risks are. Want exposure to the S&P? Sell a put, buy a call, or do both at the same time. Go long the underlying and overlay a put spread, or overwrite with a call, or again, do both at the same time. S&P options are as efficient as can be. It's a beautiful risk transfer vehicle, and there's no free money waiting to be had. However, the vol surface can be either a tailwind or a headwind with respect to trade construction. For the 95-105 collar, at current market prices, it's a headwind. Use the put spread, but not the collar. While I do not believe the trade construction is favorable for a 3-month 95-105 collar, it's certainly the case that it's liquid and easy to get into and out of. There's an old saying about Wall Street structured products. They are, quote, sold, not bought. It's a concise way of capturing the asymmetry advantage of the seller over the buyer in understanding the value of the products. There was a recent Bloomberg piece entitled Macro Hedge Funds Play Index versus Index in Niche Option Trades that discusses the OTC light exotic space. Featured in the piece is recent interest in outperformance options. This is in the category of options with more than one underlying, versus a vanilla option in which we are asking whether a single underlying will under or outperform a fixed value, the strike price. These options pit one asset against another. In addition to the volatility of both underlying assets, the outperformance option must also incorporate the expected correlation of them. Similar to a vanilla option, the higher the volatility input for each underlying, the higher the price of the outperformance option. The correlation input, however, works the other way. Here, a higher assumption in the model serves to lower the option price. The volatility of the spread on two assets is lower when the assets are highly correlated. For more on that, just ask LTCM's John Merriweather. The forward level of volatility is very difficult to model and predict for any asset. When you fire up your electronic option trading platform and buy an option with nearly zero friction, it's not because the seller has a great handle on what the future realized volatility of the underlying will be. Rather, it's simply that the market is so liquid, the seller can simply free ride on the deep price discovery already in place. There's no transparent and liquid market equivalent for options that embed two underlyings. There's no screen to look to. This creates risk for both buyer and seller. The seller suffers from the, quote, winner's curse. There's a great scene in War Dogs when Ephraim and David find out that they won the government ammo business by bidding a staggering amount below the next best. They quickly go from exhilaration to a sickening feeling that they left a ton of money on the table. When evaluating whether to use a vanilla option, an investor should consider it versus a basic long or short position in the underlying. What value is there to utilizing the option structure? For an outperformance option, we should similarly start with a long-short spread implemented in Delta One format. Relative to this, what value is there to utilizing the outperformance option structure? Again, it should come down to the option cost versus the volatility of the spread. Back to the Bloomberg article, one of the trades explored is Euro stocks over CAC outperformance options. The 3-month realized correlation is shown, and that correlation is unsurprisingly very high, ranging from 85 to 98%. I don't know what the correlation input used to price the options is, but unless there's some very natural offset to the risk that allows it to be recycled by dealers, I'd be very surprised to see it anywhere near the midpoint of the range. Correlation is notoriously difficult to predict. Thus, the dealer, facing unpredictable hedging costs, needs to add a fair amount of margin for error to the option price. In using an outperformance option, an investor is essentially paying for the right to walk away from the spread if it goes against him. My suspicion is that the investor is likely paying too much for this right. And if the entry price had some friction, the unwind price will surely have more of it. Back to the notion that structured products are, quote, sold, not bought, the piece finishes with this, quote, following an active push, interest in Euro stocks over CAC 40 has been growing as clients look to hedge potential turmoil in France, according to Bank of America. Sold, not bought. Like the Hotel California, with exotic options, you can check in anytime you like, but you can never leave. Having an escape plan is critical. All right, let's try and get to the finish line with some discussion on market signals. They say that Dr. Copper has a PhD in economics. I say that Dr. Correlation has one in finance. Our search for meaning in markets, in the why of asset price changes, is mostly the topic of conversation among us. As we hunt for attribution, we sometimes need to take a beat and realize that some of the correlations we get hopped up on will in fact prove to be fleeting. There are so many combinations of correlations that noise is just inevitable. Take them seriously, not literally, as the saying goes. With this acknowledged, I encourage you to listen to my recent podcast with Ken Rogoff, exploring his new recent book, Our Dollar, Your Problem. Ken's work is an excellent history of episodes of international crisis and a cautionary perspective on U.S. vulnerability. One of the points he makes around the historical appeal of the greenback has been its insurance property. That is, the dollar typically rallies during times of global tumult. The GFC and COVID are two recent examples. Yet the correlation of the dollar to the S&P in early April was the opposite. 1-month realized correlation between the two peaked at a positive 67% in May. Over the last 5 years, there are 13 occurrences when the S&P fell by 1% and the DXY fell by 50 basis points on the same day. 6 of those times have happened since March. Back to correlation. There are risk-on episodes of dollar weakness, and there are, as just noted, risk-off episodes. We should watch the correlation between the S&P and the dollar very closely. Stocks down, dollar down is an especially troubling combination. At 4,100 words, I've probably given you enough to chew on for now. As always, I appreciate you being a listener, and I wish you a most prosperous week ahead.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.